Depends on the cross-border investors are mainly interested in value-add products in secondary locations. We have the Blackstones, we have as well as Grove International, who bought Aurelius Real Estate in Q1. So this changed, I think, a little bit due to the fact that German investors are mainly interested in core plus in the top 5 locations, as Markus said. If you know the market, you can go to the so-called knowledge centers or the university centers, but you have to understand the fundamentals there and who are the main tenants, what is the potential exit option you have there.
I think 2 things are happening. A, of course, you have the interest of the Asian American money. Obviously, companies like CBRE and Jones Lang are making it very evident that the money is there. The question is how much traction will that actually be put onto the market, i.e. what are they actually going to pick up? I mean, the amounts of money out there are staggering. You know? And of course, a lot of that will move towards a secure market like the German market. The big 5, I think, is going to be the first thing. If they move into the B locations, I don't know. But it's there. And the fact that it's there and it's being proclaimed that it's there changes the sentiment of sellers and of the movement of the market. So that does bring in not only a pricing issue, but it moves the core investors into a core plus aspect as well, who've been there for a while. So they'll take a higher risk because the pricing is pushing them out, and they'll leave it to the next wave of core investors. So we're going up the risk scale as well because we know our markets, we've got our asset management teams, as all the other guys who've been investing with the last 4 years. So we're moving into a higher risk. Other sovereign wealth funds, Asian money, etc., is moving into that core space and can accept the higher pricing, especially Asian money and US money. If you look at their comparative markets, it's still looking like a good deal. Now, is that going to go on for a longer period of time? That remains to be seen, but it is changing the environment and it is giving it more liquidity and more flexibility and a higher range. That gap between 2-3 years ago, all we had was core. And nothing else was being traded. So then the opportunistic segment came in and the added value was void. So now the added value is being moved in both on the opportunistic side and on the core plus side. So that yield gap between those 2 segments, especially in the big 5 and also moving into the smaller countries, that's still there, but that's going to close in the next 2 years as well. And those core segments here are being fed by US and Asian capital, depending on their couleur.
Good. Markus, you want to come in on it?
I would agree to a certain extent saying that the US money is targeting, but I think if you look at Asia, there's an interest of Asia from Asia on Germany for a while, but I think still it's more or less of an interest. They're still building up their minds, but it's not really that you have seen so much deals of Asian capital or of Asian-backed vehicles in Germany. Simply also because the lot sizes of a lot of the single asset deals in Germany, given the federal structure, is not what you see in Paris or London. So it's much easier for them to deploy the capital in London, and especially as they have their base in London, going for Germany is might be their second choice given the stability, but for them it's still also a little bit of problem finding the product, finding the lot sizes necessary to really make an investment feasible. Because everything below 100 million is nothing they're really targeting at.